As most of us probably already know, virtually every person in the world, regardless of where they live, will have to pay taxes in the country they live in. Now, taxes are an important part of any modern society and helps pay for many national programs such as the military, public education, law enforcement, among others. Although paying taxes is an important part of being a citizen in your country, there are many legal ways that people can actually reduce or even eliminate their tax bill. And believe it or not, the government actually wants you to do this, and is the reason why these incentives are in place. See, there are many ways businesses and corporations are able to save in taxes, and we've covered those in previous videos. But today, let's go over how the average person can save in taxes, not just corporations. Now, depending on where in the world you live, these strategies might be a little different, but they are consistent in most parts of the world. Now, a quick disclaimer. Always work with a tax professional before making any tax decisions. This video is for education purposes only. Now, to illustrate how the average person without a business or a corporation can lower or eliminate their tax bill, let's use a few scenarios. Let's visit the Smith family, a couple in their late 30s with two younger kids in elementary school. The Smith parents together bring $103,250 per year from their full-time jobs. This puts them in the 22% tax bracket, which means they would have to pay $24,722 in total taxes if they lived in the state of Oregon. But since they are in their late 30s and have a good income, they decide to put a strong emphasis on saving for retirement. So they put $19,500 each into their 401k, which is the maximum amount they are allowed to invest in for the year. They also put $6,000 each into their IRA, which is also the maximum amount allowed for the year. So together, they contributed $39,000 to their 401k and $12,000 to their IRA. Contributions to their retirement accounts are done with pre-tax money, meaning they can use these contributions to lower their taxable income. In other words, they save money for retirement before they pay taxes. Since they have kids, they have to pay childcare after school and during the summer. So instead of paying this out of pocket, they use a childcare flexible spending account provided by their employer, which allows them to spend this money for childcare pre-tax. With their kids, they are certain that they will spend at least $2,000 on medical or dental expenses, so they use a healthcare flexible spending account, which also allows them to pay for these medical expenses with pre-taxed money. So altogether, their tax year looks like this. They have $103,250 in combined yearly income. Since they are married, they file their taxes together as a married couple. We can deduct the $39,000 they contributed to their 401k from their total income since it came out of their salary pre-tax. They also contributed $12,000 to their IRA, so we can deduct that from their total taxable income. They also contributed $2,000 to their healthcare flexible spending account and $5,000 to their childcare flexible spending account, which both come out from pre-tax money. This means that after these pre-tax expenses, they are left with a gross income of $45,250 from their $103,000 income. From this $45,000 adjusted gross income, they take the standard deduction, which in 2021 takes off $25,100 for married couples filing together. This lowers their taxable income to $20,150, which puts them in the 12% tax bracket. This means that out of their $103,000 they made, they would have to pay $2,020 in federal taxes, which is an effective tax rate of 1.96%. But since they have two kids, they take the Child Independent Tax Credit, which gives them up to $3,000 in refundable tax credits per child. This reduces their tax bill of $2,020 to $0 for federal taxes, and they actually get a tax return of $3,980, making their effective tax rate negative 3.85% out of their $103,000 income. The Smiths did not have to pay any federal taxes and actually got money back from the government because they played the tax game the way the government wants them to do it. The reason why it is possible to reduce or eliminate your tax bill is because the government encourages certain actions like saving for retirement, saving for college, or donating to charity. There are many tax incentives that the average person can use. One of them is putting money on a retirement account like a 401k or an IRA. This takes money out of your paycheck pre-tax to be invested and later withdrawn at retirement. Now, this does not eliminate taxes. It simply defers the taxes to the time the money will be accessed at retirement age. Once the money is accessed, this income will be taxed as regular income. Now, most retired people have lower earnings than in their working years, putting their retirement income in a lower tax bracket, therefore paying less taxes. Another way people can save money in taxes is by saving for college. If you have kids and plan to help them with college expenses, you can put money into a 529 plan, which invests the money to grow over time. Although contributions to this account are not pre-taxed, any earnings this fund produces are 100% tax-free as long as they're used to pay college expenses. Something that many people don't use or even are aware of are FSAs, or flexible spending accounts. These are savings accounts that an employer might provide where the worker can allocate pre-tax money to pay for medical expenses or childcare expenses. This can be great if you are certain that you will spend a certain amount of money in the coming year. The downside of a flexible spending account is that although they use pre-tax money, which can help you save money in taxes, if they are not used, they can be lost. This means that if you put $2,000 into a healthcare flexible spending account, you will have to use this money before the end of the year, otherwise you will lose it. This is not a problem if you are certain that you will use this money by the end of the year. As you can see, there are many ways that we can lower or eliminate our tax bill. Of course, always make sure to check with a CPA to help you navigate the complex world of taxes and take advantage of the great incentives that are available to you. It's always a good idea to plan your tax year with your CPA ahead of time to take full advantage of potential tax credits. Most people start thinking about their taxes when it's time to file them, but by that point, it's already too late. Now I want to give a big thank you to our sponsor, Blinkist, for making this video possible. You see, Blinkist takes the top non-fiction bestsellers and puts them into 15-minute text or audio explainers, so you can listen to the main ideas of a book podcast style. You can learn about topics like philosophy, history, and science, or dive into psychology, health, nutrition, personal growth, or one of my favorites, finances. You have thousands of the best titles in 27 different categories to choose from. And now they have a new feature called Shorecast, where you can get the main ideas of a podcast much faster. One of my favorite features of Blinkist is that I can download and listen offline. I personally love to travel, and being able to cover a couple of books while I'm traveling makes that time that I don't really do anything actually beneficial. Especially when I want to dive deep into a book, because with Blinkist you can download full-length audiobooks at a massive discount, up to 65% their retail value, which basically pays for itself. But right now, the first 100 people to click on the first link in the description of this video will get an entire week of premium access to Blinkist absolutely free. So join the 14 million users already using Blinkist and expand your knowledge with Blinkist. And as always, thank you for watching, and I will see you in the next video.